silver is still more volatile generally than gold. This is a 4-digit move for us. We've spoken about the localized high of $333 that you might get a bit of chop and churn around there, but then go onwards. And our exit strategy is based off the gold-silver ratio because we're expecting such high degrees of outperformance. So for me, more to come. However, nothing goes up in straight lines, and we did cross a couple of key technical levels. I'm wondering, there's a couple of big levels here, Elijah. We've got 5K looming on gold, and we've got 100K looming on silver. And I'm wondering if, for headline reasons, there might be a little bit more drama in between now and the actual running of that my $5,100 level for silver, which, by the way, puts us very close to the 50 gold-silver ratio.
The silver market is setting up for a massive hockey stick event where patience pays off exponentially. Experts warn against selling early, citing Hunt's Law of Parabola, which states that 75% to 80% of all gains occur in the final 10% to 15% of the move. While some investors are taking profits to cover living costs, analysis of inflation-adjusted charts suggests the real rally has barely begun. The market is eyeing a 4-digit valuation, with a localized target of $333 serving as a mere pit stop before the parabolic phase truly accelerates. Francishunt, known as the market sniper, urges Americans to hold their positions, warning that selling now forfeits the manna from heaven awaiting at the parabola's peak. He argues that current prices, when adjusted for CPI inflation, have only just cleared the 2011 highs in real terms, projecting a further 700% outperformance against official inflation numbers. Hunt describes this investment profile as a hockey stick curve, where a sudden vertical ascent rewards years of desert walking and stagnation. Consequently, the exit strategy should not rely on dollar price targets like $100 or even $333, but rather on the gold-silver ratio to signal the actual top. Hunt views this as a generational wealth transfer, emphasizing that the biggest gifts come at the end. Succumbing to the temptation of early profits during the initial momentum could cost investors the opportunity of a lifetime. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We had an excellent surge, real, for me, generational wealth being made and furthermore to be promised. I fear, and having spoken to you and you were mentioning, anywhere between 35 and 50% of the sellers are actually potentially needing to take profit for cost of living based reasons. I would certainly suggest that might be the only sensible reason. If you are in silver and you've done well, I want to highlight the Hunt's Law of Parabola, and that says, 75 to 80% of your gains comes in the last 10, 15% of the move. So if you're doing great now, trust me, you're going to be doing unbelievably well in that final part of the move, providing you don't get completely dopamined up by momentum, which is a crazy old drug of its own. But this is a 4-digit move for us. We've spoken about the localized high of $333 that you might get a bit of chop and churn around there, but then go onwards. And our exit strategy is based off the gold-silver ratio because we're expecting such high degrees of outperformance. So for me, more to come. However, nothing goes up in straight lines, and we did cross a couple of key technical levels. I'm wondering, there's a couple of big levels here, Elijah. We've got 5K looming on gold, and we've got 100K looming on silver. And I'm wondering if, for headline reasons, there might be a little bit more drama in between now and the actual running of that my $5,100 level for silver, which, by the way, puts us very close to the 50 gold-silver ratio, which is a separate discussion, but I'm sure you'll take me there once I've completed my opening comment. So let's take a little run at the gold silver ratio. I'll pass by silver just on the way there, though, because it's such an important market for so many of us, and many people want to see a little bit more around that. What are you looking at here? It is a silver chart, but not as you're used to seeing it. It's a silver chart adjusted for the CPI inflation. I don't agree with the numbers. I think they grossly overstate. I think it's like labor understate. My apologies. Let me re-say. The labor numbers are overstated. They're worse than people think they are. And inflation numbers are understated. But anyway, if we debase silver's price performance, you've actually only recently taken the 2011 high on allowing for the all-urban CPI rates. So that brings things looking far more less extreme. People are absolutely bedeviled by the scale of the move. We have, in my opinion, and since then we've done 3 separate impulses over a better part of 64 to 24. We're talking the better part of 60 years. We're already now 62 years into this entire structure. And we kind of broke in 24. We were highlighting that with you. We've been with your channel now quite a long time, and we continue to thank you for supporting us, and we hope our support is and our commentary is useful for your viewers. But just to put this into context, we're expecting, don't look at the number, it's not meaningful, it's divided by the inflation rate, but this is a log scale chart. It's very deceptive. If I were to just for a second just put you back on regular and show you that number, that's what I mean by the law of parabola. Okay, that's where we expect you to get. I'm going to put that back on the log scale because it's almost too big for people to conceptualize. And I'm just going to do a percentage move for between here and target. In other words, this is the outperformance we are anticipating for silver against the inflationary statistics that you are given for all urban people. And that's still a further 692%. If we just leave it at 700%, we actually expect outperformance. You don't stop at the purple line. So if we just say 700% plus, that is 8 times against an inflation number as well. So it's not against a fixed level line that is the dollar, against an inflation number. And we spoke, so please, unless you really have to, try avoid selling your silver is my message to all Americans. I want to see you survive this. I want to see you thrive through this. Your silver is your friend. He's going to continue to be your friend. And the biggest gifts come at the end. Trading is a hockey stick career. I'm lucky to have made it across the desert to the hockey stick part. And investing in silver is also a hockey stick event. There's a lot of desert walking, and then suddenly manna from heavens, biblical. I'll get biblical on you. It doesn't stop raining manna on you in the end.
The silver market is setting up for a massive hockey stick event where patience pays off exponentially. Market veterans warn against selling early, citing the Law of Parabola, which states that 75% to 80% of all gains occur in the final 10% to 15% of the move. While some investors are taking profits to cover living costs, analysis of inflation-adjusted charts suggests the real rally has barely begun. The market is eyeing a 4-digit valuation, with a localized target of $333, serving as a mere pit stop before the parabolic phase truly accelerates. Technical analysts argue that investors must hold their positions, warning that selling now forfeits the manna from heaven, awaiting at the parabola's peak. They contend that current prices, when adjusted for proper inflation, CPI, have only just cleared the 2011 highs in real terms, projecting a further 700% outperformance. Consequently, the exit strategy should not rely on dollar price targets, but on the gold-silver ratio, anticipating massive outperformance as it compresses toward the 50-to-1 level. Let's get back to the interview.
Gold-silver ratio. These are actually weighted candles, so you'll see they're different thickness. This illustrates the amount of volume that is behind something. So it's not a schizophrenic chart of any kind. It is an illustrator of volume. And I'm going to just take some drawing tools off that and show you that we actually had a breakdown here. We kind of little bit missed this opportunity. So there was a gold overperformance spell just recently in the last couple of days where silver's been a little bit more muted. And that probably comes out of, I'm going to drop to 8 hours just to get a little bit more detail on the day, because I really want to show you this. That comes out of a continuation pattern to the downside. So you may recall, Elijah, we said when you leave our orange box, which was the 74 value, you should primarily stack silver all the way down. So previously, when we were staying in the containment zone, keep having a 50-50 a little of gold and silver, and then you pivot primarily silver. That is our counsel to ourselves. I'm not regulated to advise you, but that's the take we had and what we gave to our community. If I drop down one more time frame, I just want to get the 4 hour. I think that will be the best. There was a real little opportunity that provided a little bit of trading luck for us. That was kind of on the taking here. We talk about this as a continuation pattern over here on the gold silver ratio. This was in and around the 58s, 59s. You'll see that value. And this has been a silver outperformance period. So you project this amplitude down. This is HVF method. That's part of our communities. And you make that. And it gave a target of 50. It was amazing how it was just through the 50 mark. Bang, right there. And what was interesting is that since the 14th, 15th, you'll see the date here, beginning of the 14th, late 14th, the 15th, the 16th, silver hasn't got away from gold. In fact, you've had these pushbacks here, here, and here, and actually gold has been the better mover. Now, as someone who's managing a portfolio of open trades as well as investment, it was a great time to have a gold in my blotters as longs, and those have shocked me with their overperformance. And then I came and looked at the gold silver ratio, and I said, yeah, it was warning us that we let go of the 58, which is just sub 60, and we've dropped all the way to the 50 level. We're now at about 51.5, and that is once you make a target, typically you get pushback and you fail to make any new ground. And this is illustrating. And this is very short time frame, by the way, but we're able to maximize our wealth. We've done exceedingly well this year and last year as trading as well as investing. We turn that profit into stack. And this is one of the examples of how you could have biased for gold during this period and just taken some of the green out of your accounts for your silver entries that we've been enjoying all the way down here in the gold silver ratio. So we are actually in a little bit of a holding period in and around the 49.5 through to the 52s, 53s on the gold silver ratio. And we might pause here a bit. So gold has overperformed silver slightly during the spell. Overall, we're going in staircases down. This was another period where you had some gold overperformance. So let me just illustrate it. When you were coming down from the 60s, right up at 70 and down, you had a spell here where the gold fought back a little bit, and those little spells can be put. But in the long run, this is going lower. Gold silver ratio, single digits for us, single digits, and you may have a shocking spike on overreaction for a short spell that can go even deeper than the 9.9s that single digits represents. So that's Goldham's trading with the gold and silver ratio. And we've got so much more to come, which just tells you this market isn't over. This isn't, the crypto bros Bitcoin bull market where you don't even get, 6 months of favorable movement and you have a couple of shocks and awes in here. This is a far bigger cyclical event. And you can see we've come from 107, and it's good to have these pushbacks because it allows us to reload on silver, and it also means we don't get to that single digit too soon. I don't want it to happen too soon. I'm enjoying the ride. I like the setups and getting back, but this has been very, very accelerative, this spell. Since we let go around 81 over here, and we'd given you a level of 74, this is just stack silver time, but we're just getting that little pushback. We have to accept that silver is still more volatile generally than gold. That's going to remain the case. But here's my take relative to 80 and 2011, the 2 years you mentioned. This is going to be a far larger move in nominal terms, the dollar, and it's going to be far more sustained at its previous highs move. In other words, even after whatever turns out to be a pullback and setup will be sustained at a far larger period. So people's ability to time and exit will maybe not be as critical. I still think with the volatility, it helps to have technical analysis, and that's why I'm in here. But nonetheless, nonetheless, you're not going to get the complete washout, but down to $4 that you had post the 50 run in 1980, for example. And here's my reasons why. The 1980 run had speculator, my namesake, by the way, bunker hunts, chasing up the silver market. So there was a degree of cornering, but there was supply, and they chased it and they were stacking. And once they got broken, that supply came back in. This is not, and this is the irony, you've actually had a lot of margin increases recently. And you've got to understand the difference between what's driving the move. Is it a horde of retail traders with too much leverage forcing a short squeeze by charging in FOMO buy? Or is it a shortage of actual silver above ground and industrial businesses that absolutely must have silver taking delivery on a far grander scale, concerned about their ability to control and have inventory of an absolutely non-negotiable input, such as in your device, how many ounces silver? Now you're knocking out a few hundred thousand, going on millions of Samsungs of many different models. You cannot have the device, and as a percentage of cost, it's still not huge on the actual device cost, but you have to have it, even if you're paying 5 times for it. And, 5 times the cost of the silver in this device, okay, the device goes up 20%. People will have to eat that. That'll be called inflation. But in fact, it's symbolic of all the debasement of fiat currency, its buying power, and the fact that we're now getting a violent re-rating for multi-decade suppression and a shortfall. So whilst I say gold is a turbocharged vehicle because it's of the inverse parabola of debasement of all fiat currencies that have been synchronized to debase, although the dollar still lost 10 or 11% to the euro last year and was one of the worst, the others were also losing value. Debasement and being a monetary metal like gold, but gold has bullion storage and plenty of supply if it were needed industrially. Silver actually has a supply deficit. There is far greater use of it. You're in negative deficit in terms of usage versus supply. And now the above ground inventory that you were eating away at is now gone. And everybody's in a mad panic to assure that at whatever price they must have. So this is not a retail leverage-based crisis of a short squeeze. A bunker hunt was just a sophisticated, very rich trader investor category. And that's why the margin increases are actually counterproductive. It's an interesting point, force and beneficial for the silver price.
The current silver rally differs fundamentally from the speculative squeeze of 1980. It is powered by a twin-turbo engine that ensures a far more sustained ascent. The first turbo is the synchronized debasement of global fiat currencies, elevating all monetary metals. The second, and more explosive factor is a critical physical supply deficit, where industrial giants must secure inventory at any price to maintain production. Unlike the retail-driven leverage of the past, this is a structural crisis where non-negotiable industrial demand collides with vanished above-ground stockpiles. Market analysis indicates that the gold-silver ratio is destined to collapse into single digits, potentially driving silver valuations beyond any historical precedent. While the ratio currently consolidates near the 50 level, technical indicators suggest this is merely a pause before the next leg down. Experts warn that margin hikes, often used to dampen speculation, will fail to suppress prices because the buyers are not leveraged traders, but desperate manufacturers. This dynamic ensures that the coming move will not be a temporary spike, followed by a washout, but a permanent repricing of the metal. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.